Okay, good morning and welcome back, everyone, to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play. And last week we had another, I guess you could call it roller coaster week after what has been what feels like closer to two stretching into 3 months of what is largely roller coaster price action here. Last week we initially had the FOMC meeting results provide a bullish backdrop here for equities as the S&P 500 briefly touched above 6,900, which is the double top resistance level on the S&P 500 before it quickly failed to hold those levels and reverse lower. And towards the end of last week, we started to see a lot more angst and anxiety from the markets, specifically around AI tech valuations and concerns that we are currently in a quote unquote bubble with regards to AI related companies. You saw a fair amount of rotation here last week as sort of the growth sector started to lag behind while the rest of the market played quite a bit of catch up here. And the market is sort of at this stage waiting on corporate earnings to continue to grow before it has the confidence to continue moving higher. Now, this week is going to be a big week. Obviously, we're very close to moving into holiday season where we expect there to be lower volumes, potentially higher volatility. But on the economic data perspective, with the government shut down here for over a month, we have a lot of delayed data that's starting to come out here today with regards to employment numbers, CPI numbers, retail sales numbers. These are all largely the biggest inputs that go into the Federal Reserve's data models to help them determine whether or not they are going to continue cutting rates or leave rates alone for a while. And the FOMC meeting last week provided with what was initially considered as a less hawkish cut than we were expecting. Essentially, what Chairman Powell did was state that he was cutting interest rates and at the same time leaving things open to seeing how the department data or how the data for the department comes through to decide how he's going to cut rates in 2026 or whether to cut rates here in 2026. So that's a big if, and that's a big primary driver here for, like I said, education as well as just for an understanding of the macro backdrop for the slowdown that we've seen in the labor market versus the relative resiliency of consumer spending, even though we're seeing those patterns shift quite substantially away from lower income households, where retail sales, while, like I said, holding up fairly resiliently, more and more of that spend is being directed as a result of higher income spenders spending more rather than a broad-based growth in terms of retail sales. So that's one area that I do think is worth understanding to determine kind of the seriousness of the macro backdrop or the macro slowing down that we've seen. So taking a look at kind of where we stand on the S&P 500, if you look at a chart here, so this is the double top that we're talking about here at 690. So you have a strong double top now. Even the FOMC meeting did not provide the catalyst for the S&P to break out to new all-time highs. This leads me to believe that at least in the short run, we are destined for potentially a little bit more of short-term volatility. Like I said, the economic data here coming out is really what's going to potentially be a driver of sentiment here into the end of the year, because the market is pricing in essentially no more rate cuts here until June of 2026. And the only thing that could really shift that model, in my opinion, is really going to be a significantly slower labor market, coupled with inflation numbers that remain in check. And we just saw, the November payrolls numbers come in, beating estimates. I haven't had enough time to digest where we currently sit in terms of those numbers, but that's really not necessarily going to be what the hawks want to see with regards to, what the doves want to see with regards to further cutting interest rates here at the beginning of 2026. If the labor market shows signs of stability, shows signs of strength here, that's really where you have the case to be made for keeping interest rates where they are. You see the same thing on the S&P as you do on the NASDAQ 100 if you look at the Qs. You have this double top that's formed here. And interesting to note that on the Qs, we haven't quite gotten back to the recent all-time highs. So the NASDAQ 100, the big cap growth index, is actually lagging the S&P by a little bit. Not by much, but we're seeing a little bit of outperformance here from the NASDAQ 100 versus the S&P 500. On the flip side, if you look at small caps, if you look at IWM, you'll see that IWM is actually broken out here above their double top here. So the IWM, after breaking out so far, has pulled back to retest that level. And the question here is today, whether or not we get that confirmation that we bounce off of this support level and continue moving on, or is this more of a false move that's now going to fail and get back into the trading range? We'll see kind of how markets play out here today, but this is going to be a pretty pivotal week for what sentiment's going to look like going into the rest of this year. If we fail at these major resistance levels and start pulling back here, then we have a much more neutral and potentially bearish view here going into the end of the year, rather than if these markets actually recover, break out above their 200-day moving average, the potential there to see further continuation higher looks a lot stronger as well. You see it with the equal weight S&P 500 index, the RSP. You look at the RSP similar to the Russell 2000 is that recently you gotten the breakout here above that resistance level. So far, it's held that level. And the question is whether or not we can continue to hold that level and move higher here, which gives us a much more bullish view going into the end of this year. Or if these major indices like small caps and the equal weight fail at these levels and start reversing lower, that's really where we have some concerns with regards to what sentiment looks like going into the second half of the rest of 2025 and heading into 2026. So that's where we currently stand from a macro perspective, looking at the ideas that we're seeing here for this week. The first one to take a look at here is ICE, Intercontinental Exchange. This is the group that owns the New York Stock Exchange. And if you look at the chart here, This is a stock that has, very clear and defined kind of boom and bust cycles. Basically, from May through August, you have this very clear and defined uptrend. Since then, you have that uptrend was broken here and continue moving lower here. And recently, that uptrend has once again reversed back to the upside. And you can draw your lines a few different ways, but the more conservative way is to draw your lines this way. You've gotten the breakout here after this bottoming formation. It's come back to retest this level as support, and this is where the risk to reward ratio looks quite favorable for some upside exposure here, because if ICE bounces higher here, your upside potential is fairly sizable compared to if ICE were to get back below, call it 160 or so, like say it gets to 157, 156, you would be able to potentially get out of this trade with a very small loss, especially if you consider that relative to the upside exposure that you have with ICE. So that's one that I like as a potential setup. Another one I like to point out here, which is Corpay, which is not a household name at all. The options aren't particularly liquid, so I actually think this is, if you're interested in this particular stock, you're probably better off potentially buying the stock rather than buying an option on this particular symbol. Corpay used to be called Fleet Corp. They used to manage gas cards for corporations, who needed to issue Visa, MasterCards for, truckers or anyone who's driving predominantly for a living to be able to use those credit cards at gas stations. They've, in the last couple of years, rebranded themselves as a global cross-border payments and expenses platform. They've been able to grow double digits growth for multiple years now as a result of sort of transforming their business, which now accounts for more than 60% of their overall business. They are growing quite successfully in terms of growth. We're seeing low to mid-teen year-over-year growth for both top and bottom line. And more importantly, it is incredibly profitable, with net margins approaching 25%, which, if you compare to its peer group of only around 9% in terms of net profit margins, you have a company that's far more profitable. It's growing substantially faster, yet it only trades at a valuation that's just above 50% of the rest of the industry. And that, in my opinion, really reflects the fact that people still think of this company as a fleet, gas card company trading at a much lower multiple rather than a SaaS, enterprise SaaS platform that caters to, call it, the accounting departments and finance departments of Fortune 500 companies. They service some of the largest institutions in the world with regards to helping them manage their expenses and accounting practices. However, that's really where I think that there's a huge opportunity here for a lot of investors that just have never heard of the company. The next one to take a look at here is Lululemon. Talked about Lululemon here last week, and Lululemon reported earnings last week, and after reporting those earnings, the stock jumped higher from that. So that confirms that we have this kind of bottoming formation being complete. That was our hypothesis, was that the stock has taken such a big hit. It has now spent multiple months forming that base, and it has that potential here to break out here and continue moving higher. So far, based on price action, we got the breakout higher as a result of the earnings last Thursday. The earnings this morning also was further supportive of potentially further upside here for Lululemon. You have the stock trading around 16 times forward earnings, which is incredibly cheap relative to the industry, which is trading closer to 21 times forward earnings. So you're looking at nearly a 25% haircut on valuations. And typically that would make sense. Um, However, as Lululemon continues to focus on its rebrand, or rather, sorry, focus on converting kind of their brand to growth, which is something that they've struggled with over the last a couple of years, and that's why the stock has taken such a big hit. But overall, I think that the brand is intact. They're starting to see some meaningful strides with regards to recovery of their in-phone sales. And that's really where I think investors are taking a second look here at Lululemon after what has been kind of the redheaded stepchild, this year so far. The next one to take a look at here is Truist Financial. We talked about this last week here as well. Truist Financial is a regional bank that recently started to break out higher here, and the breakout has actually been coupled with a fair amount of outperformance, which is a really good sign here um, for financials. We're seeing it across the board for a lot of financials. We're seeing it in both major banks, regional banks, asset managers, um, exchanges. They're all currently seeing the inflows as a result of lower interest rates. And Truist Financial, with its regional bank, commercial real estate portfolio, it tends to be fairly sensitive to interest rates, and that's why ever since the FOMC meeting decision to lower interest rates, this stock has particularly performed quite well. And I think for anyone who's interested in Truist Financial, you see that it's trading at a pretty significant discount to its peers. Out of the regional banks, it's definitely one of the lowest in terms of valuations. And that's what presents the opportunity here, especially if you look at kind of year over year growth that's expected for both top and bottom line. We're talking about numbers that are kind of industry leading, well above the major banks, something I think at this stage only some of the smaller regional banks can potentially produce. And Truist is definitely out of the regional banks, one of the largest. But like I said, we're seeing kind of similar price action on Bank of America. We're seeing it on the Wells Fargo. We're seeing it on asset managers like Ameriprise Financial, LPL. So you have a lot of potential opportunities to take advantage of a continuation higher here in financials, even if you're not as comfortable with Truist or if you're not looking for a regional bank. There are opportunities in major banks and capital markets as well. Okay, the next stock that we want to take a look at here is we'll take a look at Akamai. So Akamai, as you can see, this is a stock that over the last year or so has really struggled. But at the beginning of November, the stock has really took off here. It came back to retest this level of support, and we're looking for potentially a bounce higher here and continue moving. Akamai, similar to some of the other opportunities that we showed you, is trading at a very steep discount. It's trading at 11 times forward earnings. So if you factor that in, the fact that it's essentially trading at a 50% discount to its peers, if you look at growth expectations, they are just slightly below average. So like I said, you account for that in your valuation here, but the company is trading at 11 times revenue versus something higher that is just simply more manageable. But Akamai really has rebranded them, or not just rebranded, but refocused their business on providing edge computing for AI versus the traditional content delivery network that they used to operate. That's become sort of legacy software for them. It still accounts for nearly 40% of their revenue, but edge computing specifically for AI companies is really where their focus is. And if they are successful in their ability to do that, that would certainly take away the commodity type valuation and take a look at this more from an enterprise SaaS perspective, which is really how I view Akamai at this stage. The next one I want to take a look at here is Accenture. If you look at Accenture here, similar price action to some of the stuff that we're showing you here before, essentially a stock that has over a period of time really struggled, but then over the last, call it, few months have formed this base here and recently broken out from that base, and we're looking for that to continue moving higher. Accenture trading at 19 times forward earnings, which is about a 10-15% discount to its peers. Um, Growing potentially not as fast as its peers, but more profitable. So trading at a valuation that's below its peers justifies, in my opinion, at least a mild upside potential here, to play a little bit of catch up from a valuation perspective. And then next one I want to take a look at here is Edwards Lifesciences. This is a medical technology or medical devices manufacturer. As you can see, the recent breakout here above, call it 82 and a half, we've seen a retest of that level. And this is really where the risk reward looks quite favorable for potentially some upside potential here. Edwards Lifesciences is trading at a premium relative to its peers, but it is growing faster and it's far more profitable. So to some degree, you can justify a higher valuation here for stocks that grow faster and are more profitable versus their competitors. And looking at some of the bearish ideas that I wanted to share with you, the first one I want to take a look at here is Cloudflare. Cloudflare, as you can see here, this is a stock that has been on a really giant tear here this year. But as you can see, the stock has traded sideways here. The trend quality has continued to deteriorate from what is green to yellow and green, now to both candles have turned red. So the trend indicators have recently turned negative here. And you can maybe potentially draw your lines a few different ways, but one to my eye that looks like is the potential formation of a head and shoulders topping formation, which could suggest that we get back down to as low as $130 here on Cloudflare. And what's really interesting about this particular stock is that it's trading at, on an earnings basis, about 168 times next year's earnings, which is, in the same realm as Tesla, but where Cloudflare really sits on its own is, a lot of companies that are just turning profitable, the earnings multiple is just not a good multiple to use because the denominator is close to zero. So you get these really overinflated valuations that may not always be true just because the denominator is so small. It forces the ratio to be so large. The other metric that you can use for some of these companies that are either not profitable or just expecting to be profitable is looking at price to revenue. So looking at how much revenue are they bringing in, or how much money they're bringing in from their business, and then allocating kind of the uh, the valuation to that. Now, Cloudflare, trades at 36 times revenue. So, there's really no company in the S&P 500 that's approaching 36 times revenue. It's just in a league of its own from a valuation perspective, and that's why I wanted to show this to you potentially as a bearish setup that we currently see here in this environment where anything with AI or anything related with these really high growth tech names are starting to see some downside. Cloudflare, with its ridiculous valuation, really sits in the crosshairs of investors who are looking out for kind of signs of excess in this market. The last one I'll leave you with here is Affirm Holdings. So as I said at the top of the show, consumer spending has held up quite well. But that's not all roses, in the sense that the lower income cohort has continued to erode in terms of their ability to spend. So if you look at Affirm, PayPal, any of the buy now, pay later platforms that are catering, generally speaking, to a lower income group, those are ones that are likely going to start seeing some further delinquencies in terms of those loans, which would force a lot of these companies to tighten their lending practices. But these companies all operate on very thin margins. So as soon as they start tightening their lending standards, revenue is going to fall, profitability is going to fall, and a firm trading at 78, 79 times forward earnings, these are the types of stocks that could potentially get hit the most in this type of market environment. So be cautious and be careful for some of these names. With that, thank you so much. I hope you guys have found this useful in giving you a better understanding of our macro view while providing you with some of the ideas for today's trading session. With that, thank you so much. I hope you guys have a great trading day, and I'll see you guys here next week.